Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast. Lots to talk about this week, so let's get straight into it. And we'll start with you, Blake, this week for your latest thoughts on the US.
Yeah, thanks, Imogen. So I guess to start off this week, what we've really seen is the kind of higher everything trend that's persisted over the last few weeks. Seems to be taking a little bit of a pause. 10-year yields slid by about a basis point yesterday after rising for about 8 sessions. We've seen the same. S&P 530s actually started to flatten a little bit. We've seen spreads, which have really been leading this move, pushing higher. We've seen those actually start to retrace a little bit. So it seems like that kind of move we've had for the last week and a half is breaking in momentum a little bit. Obviously, we'll be pretty focused this week on supply. We've got 10s and 30s, 10s today, 30s later this week. How the market takes that down, I think, is going to do a lot to kind of set the direction and set the tone for the next leg of the move. And obviously, we'll have Powell, who we'll all be watching as well.
Giles, it's been a busy week, particularly for supply. We've had 2 heavy weeks of supply this week. So what are your latest thoughts in Europe?
I suppose that the answer to that question is that it's really just a reflection of what you've heard from Blake already. It was a very heavy supply week last week, and that was part of the mix for European rates. But I mean, what was really interesting for us was that it was the first time this year that we've really seen European rates participate in a global move in that way. It was really nearly 1-for-1 with US rates, and that's something we've been calling for, we've been waiting for quite a while, but it was nice to see it happen. Now this week it seems like people are just taking a little bit of a pause. Now I think we need to see how people feel about these sorts of levels. It seems like people have been thinking a little bit more about how they want to position in case we see a bit of a retracement of the move. But overall, I would say that there is weak sort of belief in the possibility that this could continue.
Great, thank you. Theo, over to you, although I'm sure you're going to tell a similar story that the UK rates are now catching to the US as well.
Yeah, the UK is really participating in this move, in this backup in rates. It's very exciting because the UK stood out as the market where rates were lower, and there was a lot of discussion about negative rates, lower rates, etc. So this obviously changed as of last week, and the whole front of the curve is repricing higher. At the same time, the very important part is market perception with regards to additional supply. So this week we had a big syndication also in the UK. It was a Linker syndication, a new bond, Linker 51s. Now, while the bond itself was easily absorbed, we can see that there's been a weakness at the back end of the conventional and Linker curve. So yes, fine, supply does get absorbed, but the market does require higher rates. And also in the UK, we've seen the theme of a steeper curve playing out.
Great, thanks, Theo. So Blake, one of the things that we discussed a couple of weeks ago was the quarterly refunding announcement with regard to the treasury, and the fact that they really provided very little clarity, I would say, a disappointing amount of clarity, given we were waiting for a lot of news, particularly around fiscal stimulus. That hasn't really changed that much, but one thing that we are clear on is that their cash balance is headed significantly lower in the coming months. Can you just talk us through that and why we really care about that, I suppose?
Yeah, thanks, Imogen. So, as you mentioned last week, we were a bit disappointed that we didn't get a little bit more clarity out of Treasury regarding, what they're going to do with bills, where the cash balance is going. We kind of have some idea. They presented some numbers for the end of March and June of where they think cash balance is going, but we don't know what they're including in those forecasts. We don't know, how quickly they'll get to those levels, whether they're targets or really just kind of forecasts of where they think things might be going. But I think one thing that the market and Treasury seems to be pretty sure on is that the cash balance will be going down. This is significant for markets, and I think there's been a lot of focus on this because every dollar that the TGA basically draws down is another dollar that goes back into the banking system, into reserve balances. The TGA, as we call it, the Treasury General Account, this is essentially just a checking account that the Treasury has at the Fed. They pay all the bills of the government, military, Social Security, all of that kind of comes out of this TGA, including any spending that's going to be associated with an additional stimulus package that may or may not get passed, and also the stimulus package that was passed back in December. Both of those are going to be helping to kind of draw down this cash balance as they write checks to basically pay for those things. As they do that, that money then becomes part of the banking system. And at the end of the day, will sit on some bank's balance sheet as a reserve balance at the Fed. Right now, both of those things, reserves in the system and the Treasury's general account at the Fed, are at or near record highs. TGA typically is around 300, 400 billion before COVID. Now it's at 1.6 trillion. Banking reserves similarly are near record levels, over 3 trillion. So really big numbers here. And, if you think about this idea that they have 1.6 trillion in the account right now, Treasury does, if they take that down to, 800, which is the number that they suggested they may get to by the end of March, or if you take it down to 500 by the end of June, like they suggested, that's over 1 trillion of reserves just surging onto the system that's already got over 3 trillion record levels. And even now, the level of reserves that they have in the system are already starting to cause some problems. We've seen front end rates across the spectrum start to basically leak lower because of all these reserves, all this liquidity sloshing around in the banking system. If you could kind of sum it up, you basically just say funding dollars has become extremely cheap. It's true for unsecured. LIBOR hit all-time low. It's true for investors in other countries. It's extremely cheap to borrow dollars in cross-currency basis markets right now. It's true of secured funding. Repo has started to tick down to towards zero the last few days, trading extremely soft. And it's even true for the US government, who's likely to pay zero at some of the upcoming bill auctions to raise cash. So basically everywhere you look, there's just a ton of cash in the system, very little demand for that cash. And so I think that's why everybody's so focused on the fact that we're going to get this additional dump as Treasury starts winding down this cash balance.
So just to quickly recap for anyone that's listening, how can the Treasury decrease cash balance?
Well, and this is one of the areas where, we've been hoping for maybe a little more clarity on. They can reduce it just through the normal course of spending cash. That is money in their checking account. And if they write a lot of checks, that cash balance will go down. So if they pass a big stimulus package, that's something that will help to pull that level down. The other way is they could pay down debt. So usually when they reduce their cash balance, it's because they are paying down bill supply. That's actually kind of an interesting piece, because paying down bill supply, you actually get a double whammy here, because if they pay down bill supply, you've got the cash moving from TGA into the banking system via reserves, but you're also reducing the amount of bills in the system, which are investment options for very short end investors. So you're taking away bills from the market, and now money funds, central banks, other people that typically buy bills are going to have to find somewhere to put that cash. So you've got more reserves in the system sloshing around, and Treasury's taking away places to put that cash by reducing bill supply. So it's kind of a double hit if they reduce it by cutting bill supply.
Okay, so if we think about how this relates to the Fed, did they care about this? And if they do, what?
Well, yeah, they do care. Obviously they implement policy via front end rates. That's their main policy instruments is exerting control over front end rates, and their belief is that kind of filters out through financial conditions. It's not that having these kind of front end funding rates that I've been speaking about, they're moving, from, let's say, 10 basis points down to 4 or 5, or if you have, these kind of small several basis point moves in these front end rates. It's not that that's going to crash the economy, or that, that really has an economic impact. But I think for the Fed, it's more of a credibility issue. That's their method of control. And if it looks like they don't have control of those rates, people could lose faith in the Fed's ability to control the economy. So that's, I think, why they care most about why these front end rates. There's obviously some financial stability concerns here as well. I don't think those are as important right now as the credibility issue. A lot of people point to SOFR in particular, the secured overnight funding rate. This is the repo index that the market is moving to as they move away from LIBOR. This is the chosen successor to LIBOR. So a lot of people have pointed out that the Fed should care about where these rates go, because SOFR, is this new benchmark, and they don't want SOFR to start, trading super low or to have a high amount of volatility. So there are things that they're watching there. In my opinion, I think they care most about the Fed funds rate. They have an explicit target for the Fed funds rate. They say we're going to keep the Fed funds rate from 0 to 25 basis points. That explicit target, I think, is really what moves them the most. And in the past, that's been the case. Whenever they get within 5 basis points of their targeted range for the Fed funds rate, we've seen them move and we've seen them take action. So, I really think what they're going to be most focused on is where the Fed funds rates trades. And that has started to slide a little, but has perhaps not moved as much as bills or some of these other funding rates that I've mentioned. But it is starting to decline, and if we get down to that 5 basis point level, I would expect the Fed to take some action.
And what would that action look like, do you think?
There's a number of things they could do that aren't as direct, but the most direct levers that they basically hold over the Fed funds rate and in turn all of these other front end rates are the two programs where they basically set the rates for. So IOER or IOR, this is interest on excess reserves or interest on reserves. Not really that just relevant of a distinction at this point. This is just the rate that banks get for basically having reserves at the Fed. So the Fed can set that interest rate. They also have an overnight reverse repo program. Basically what that is that money funds, a number of money funds, banks, and GSEs, so this is like the home loan banks, Fannie, Freddie, can basically give cash to the Fed in exchange for collateral in a repo transaction overnight and get paid some rate. This sets a pretty hard floor under rates, because if all of these kind of front-end investors, the home loan banks, money funds, if they can invest at the Fed for a certain rate overnight, secured basis, there's really little reason for them, and there's no real potential that they're going to go out and lend to a bank for any rate below that. So it really kind of sets a floor under the rates. IOER ends up being kind of a ceiling. Banks can get paid this rate from the Fed, but I think this is the real key here, is that the home loan banks, the GSEs who have reserve accounts at the Fed, do not get paid that rate. So they actually have an incentive to lend to a bank for a level below IOER, because then the bank can actually turn around and earn IOER on that, and there's some kind of spread. It's a little bit of an arbitrage. So my guess is that the Fed, once we get to that 5 basis point level, they start looking at hiking both of those rates. I think a lot of people focus more on the IOER, and a lot of the market discussion is focused on IOER alone. I actually find the overnight RP to be the more relevant rate. It's a much harder floor under rates than I think the pull from the upside from IOER is. So if you really want to move the Fed funds rate, I think the best way is to push up that hard floor rather than kind of pulling it from above with IOER. So I think they actually move both rates, just move the whole corridor up 5 basis points to kind of push effective Fed funds rate up off of that kind of 5 basis point level, and then hopefully that will also pull other rates along with it.
Great, Blake. So now just switching over to Europe with you, because one of the themes, I guess, of the past few weeks is that whilst other rates in Europe have continued to rise, actually Italian bond yields have continued to fall. In 10 years, we're very close to, or perhaps even at, when this comes out, new record lows, driven by this confidence in the return of Draghi to the government. So do we think this isn't still a done deal? So perhaps first you can just talk us through whether we think this is going to happen and the market reaction is the right one.
Yeah, well, I mean, I think the market reaction is the right one, and we do think that it's going to happen. So, very simple answers to those two questions, Imogen. the timeline is essentially that we probably, this will come to a head the beginning of next week, and very strong base case, we think that Draghi will find the support. So on the market reaction, well, we are back at very long-term tight levels for BTPs versus other European fixed income. And, broadly speaking, I'll just say, I think that that's right. It's not just because the markets, particularly the bond markets, view Mario Draghi as being little short of a miracle worker. So, obviously there are legitimate questions about whether those expectations are have gone too far or not.
If we really have a kind of positive view on what Draghi can do in Italian politics, then what is there left to worry about in Italy, or what reasons are there to not be long Italian spreads?
Well, that's exactly the point that we've been trying to make, because obviously, people look at charts, and when you get to levels that really challenge a long-established range, they ask questions, along the lines of what could go wrong. And I think it's instructive to just take a look at what where we've been over the last sort of 5 or 6 years. In 2015. Not only was the sovereign crisis still fairly fresh in people's memories, but we also had ongoing kind of aftershocks from that with Greece, and then that sort of turned into I guess concerns about populism as a global trend. We had Brexit, we had Donald Trump was elected, we had a change in government, which is actually a sort of relatively positive one from a market's perspective in Italy with the coming of Renzi. But then that turned into concerns about French politics, and then Renzi failed his in his constitutional reform, and that then brought us to the sort of later stage where we had a real blowout in Italian spreads, and QE stopped, and all these kinds of things. So there's always been things to worry about. That's the key message. But now we have historically low interest rates everywhere. So debt sustainability, as we've repeated, really shouldn't be that much of a concern for Italy. So much of Italy's debt is locked away, if not forever, for the long term at least, in the ECB. And we have all these other these other sort of European mechanisms to sort of assist this transition from this kind of crisis phase to a recovery phase. And we have someone with a proven track record, an excellent communicator with markets, and frankly, a mediator who, as I say, his record is really exceptionally strong. Taking charge of the process, in particular of the writing a plan to deploy the funds from this EU recovery fund. So all of that, I think, is an argument that we should at least be looking at breaking out on the tight to the tight side of this range. But actually, we are increasingly toying with the idea that this is a turning point for Italian politics, which is potentially more profound than just the change of a government. This is about the turning tides, I suppose, of global populism. And so there is a long-term story here, which I don't think is spoken about enough.
Okay, so I guess that means as well that we look towards other factors which would then add more kind of downward pressure on BTP Bund spreads, if we think about things like ratings upgrades, which also could then bring about foreign investor demand, for example. I guess it creates, in some senses, this kind of virtuous circle of lower yields and lower spreads for BTPs.
No, that's exactly right. I think that one of the key ingredients for certain kinds of investors is the rating. And we already said before we had this possible positive development in Italian politics, that one of the surprise themes for this year could actually be upgrades, not downgrade pressure for Italy. And while I'm not going to say that that's imminent, and it's something that we will have to look at in quite a lot more detail in the next few days, but it certainly seems like that is a theme that we want to go with, and it may just be a question of time at this stage.
Okay, great. As well, a super interesting episode this week, and as ever, a lot to discuss. So I hope everyone enjoyed it, and we will catch up next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.